you've ever been turned down by a bank for a business loan, if you've watched the branch in your neighborhood close its doors, this is the story of who started lending when banks walked away and whether that's a lifeline for our community or the next bubble waiting to pop. Welcome to Money Market Briefs, where we discuss all things private equity and private capital. I am your host, Tariq Collins, and this show is brought to you on behalf of the Capital Alliance Network. Listen, don't forget to like, share, and subscribe so we can bring you the best content, bring guests on the Money Market Briefs to give you the updates on what's happening in the private markets around the world, right? Listen, why does this matter to you? Because the banks pull back from exactly the kind of lending that our businesses depend on, the small loans, the local deal, the borrower who just doesn't fit a rigid computer model. And when the bank stepped back, somebody else stepped in. Understanding who's doing the lending is understanding who controls access to capital in our communities. And that's everything, period. So here's the question. How does an entire $1 trillion lending industry grow up almost overnight? Outside of the banks, most of the public view, and most of us never even noticed what's happening. Well, here's the answer. Private credit is a non-bank, privately negotiated lending. The fund is your lender, partner, and negotiator, not a bank that chops your loan into pieces and sell it off. The main strategies for private credit is direct lending to mid-market companies, distressed or opportunistic, asset-backed, and a specialty consumer finance. So these guys are direct lending from their fund to you, your business that needs the lending. So you don't go through traditional banks where banks have constraints. The private credit don't in more ways than not, right? It grew out of leveraged lending in the early 80s and 90s, then exploded after the 2008 financial crisis. So this private credit thing has been around for a long time, and some companies has been doing it. Asset managers, hedge funds and private capital or private equity firms have been in the private credit space. It just wasn't formally used as private credit. They were in credit. But it blew up really after the 2008 financial crisis when we had a run on the mortgages, right? So today, roughly $1.5 to $2 trillion in assets. Some banks project it could hit $5 trillion in the next several years. So this is a big industry that's been going on for a long time. Now, you assume that private credit blew up because it's some clever new Wall Street invention, and here's the truth. It's the opposite of new, right? I just told you they've been around for a long time. But lending used to be all private, one person, one handshake, one deal. That actually happened is after 2008, regulators forced banks out of riskier middle market lending. And that left a huge hole in the industry. And private credit is just Wall Street rediscovering the oldest form of lending there is and getting paid for a fortune to do the job banks abandoned. So when they restructured how banks give out loans, it put tighter restrictions on banks, right? And if you're already in minority or low growth areas, right, there's even more constraint in that. And private credit stepped in where banks could not to be able to provide companies with alternative funding or intermediary funding in between them growing or getting to banks or growing and getting to institutions that's raising capital for the company to grow. And private credit comes in and do the lending just for that. They do it based off what assets you have, right? So it's a whole lending structure, credit worthy. It's like banks. It's just a little less constraint because you're dealing with the fund manager or credit manager over that specific fund to lend to your business for whatever your specific needs are, from a public company to grow and expand, or a private company that's looking for a little funding in between funding or some growth funding to get them to the next stage for their business. And obviously the payments to the loans is a return on capital for the fund that's doing the private credit. Does that make sense? The second Wall Street realized that there's a fortune in doing the job banks walked away from, the biggest name you already know came rushing in, right? These are all the big funds are doing this. The same firms that's running private credit or private equity is now your lender And so we just want to follow the money. So all your big fund, Blackstones, Apollo, KKR, BlackRock, the asset managers, all these guys and girls are jumping in on the private credit side because there's opportunity to fund these businesses and get a return on investment. We're talking direct walk up to one of the firms and say, "Hey, we are trying to lend, or we need a loan because we're trying to acquire this company, or we're trying to execute a roll up strategy with these three companies in mind, or we're trying to grow our firm and we need money to be able to do direct investments toward these 2 or 3 areas for our business to grow. Here's what our revenue looks like. Here's what our expenses look like. Here's what our net profit is, EBITDA, if you will, how much money we have afterwards. So we have the margin room to be able to not only grow with the investment dollars that you give, but also pay back the loan with the interest and et cetera that you're looking to get, which gives the return on investment to that private credit fund, to the investors and the LPs that invested in that fund, to be able to have a return on investment for the money that they made. And it serves the opportunity where there's a gap between bank lending and getting to the everyday business owner that's looking to grow and not looking to be held up by any constraints and get after what they're looking to do, right? So when a handful of firms control who gets lent to, they control who gets to grow, basically, right? Because lending is the access to growth and capital, which is the access for you to grow your business, which is the access for you to scale your business, which brings in more opportunity, more investments, more people. You see where I'm going here. It just keeps tumbling down. And if this thing is a bubble, understand who gets hurt first when it pops is the thing that you have to consider. Is it a bubble? Is it really a bubble, right? It's not the Wall Street firms with the diversified book. It's the borrower at the edge. It's the one with the least cushion. So whether this is a solid ground or quicksand matters most to the people who can least afford to be standing on it, which means that the private equity fund or private credit fund itself is diversified. They're investing in not just you, but this person, that person, the person you know, the next person. They diversified their risk over several different investment ventures that are out there. So the risk is not necessarily on the fund failing itself. It's really on the person that's taking in those dollars, consuming those dollars, and having to do a return on investment by way of them paying back the loan, etc., to these private credit people. So if you're getting the money and you're strapped, right, you have to really be able to provide value inside your company from an operations standpoint to be able to serve a high quality product or service to high quality customers and clients, for them to go out there and change their lives or impact their lives and impact their community and provide a return back to the money that you borrowed.